Hi, I'm Robert Hirsch.
And I'm Garrett Gunderson.
And we're going to talk to you today about how to save money for your business. And there's a few ways that we're going to do it. And Garrett has been doing cash recovery systems for entrepreneurs for an awful long time. I've been doing the consulting for a long time. And some of these things, in terms of investments, you can never really have a guaranteed return. But things like tax savings go right to your bottom line right away. So this can make a huge difference, not in what you make, but in what you keep. And Garrett, really glad that you're here and really excited to be doing this with you.
Yeah, my intention here is in 20 minutes or less to find $20,000 for your life. So it's a big, bold promise, but that's the reason you're going to want to watch this, because I'm going to give you very specific things that you can look at and specific things that you could do. But before we jump to that, I do think it's important that we take just a couple minutes and talk about tax philosophy, okay? So first of all, what do you think the best tax shelter is in the world when we ask most entrepreneurs?
What's the best tax shelter? I mean, the best tax vehicle for me is a business.
Right.
But the best tax shelter.
Right, so you're absolutely right on the tax vehicle. The best tax shelter, and this is important, so this would be something to write down. Always earn another dollar. Now, not everybody thinks that way, but you got to think productively. No one shrinks their way to wealth. So no one is wealthy just because they cut everything out of their life. So sometimes people let the tax tail wag the dog, right?
One latte a day. So and pretty soon I'll be driving a Rolls Royce.
Right. So here's the thing. You always want to earn more money, because even if you earn another dollar, any of your previous dollars, they absolutely do not get taxed at a different rate. If you go into a higher tax bracket, it would only be on the new dollar earned.
Most people don't realize that. So just to emphasize what Garrett is saying and what we're talking about here is, for every dollar, so there's a marginal tax rate. So marginal means incremental, or each additional dollar. So let's say you're in a 35% tax rate and someone's like, ooh, I don't want to make another dollar. I'm going to go into the 39.6%. And they think the 39.6% rate applies to every dollar they made, and it doesn't. It's just to that single dollar. They only get 60.4 cents on that single dollar. Most people don't realize that is, really an ignorance tax and something you really need to know. So every dollar is taxed marginally, not retroactively.
The second reason this is critically important is, guess where your tax savings come from? It comes from your highest marginal bracket first. So if we save $1, we're saving off the 39.6 rate if that's the bracket you're in. We're not going to the 10% rate on the first dollars. And so I think that's a pretty critical component.
That's a huge component.
Yeah.
So again, that just maximizes the efficacy of what you're doing.
Now, I want to let you know that we're only going to talk about black and white strategy here. There is no gray area. There is no kind of things that are crazy and out there that we're telling you to be a sovereign citizen and there's no need to pay taxes. Absolutely not. We're telling you, here are the things that you can read about, that you can have plenty of people tell you, absolutely, that is part of the law.
You don't want to renounce your citizenship and live on an oil platform off the coast?
Not today.
Not for me
today.
either. No,
Right.
It doesn't seem like a great place to raise a family.
But I will tell you, existing tax professionals use a couple statements that are important for us to address. The first one that they'll say is, you know what, I'm a conservative accountant. And what I've found is, far more times than not, conservative means reactive instead of proactive, or even not up to speed with current law. That's usually what's happening. And it's almost an excuse of, hey, I want to make sure you don't get audited. Now, if someone in your accounting world tells you they want to make sure you don't get audited, you now know you're not dealing with a professional, and here's why. It is the IRS's stated intention to audit every single business owner in the United States at least once during their lifetime. So how exactly is your accountant going to keep you from being audited? Now, I've been working with accounting firms since 2000, and anyone that actually did get audited, no one's owed a single penny yet. So it's not the audit that you should be afraid of. It would be improper accounting or tax strategies that are actually evasive instead of avoidance related. And I just want to make sure you know that, because some people are being snookered, they're being fooled, and they're not taking advantage of keeping as much money as they can because they're overpaying tax because of a storyboard that just isn't true.
Right, and the IRS has been painted as the big bad wolf enough in our society that everyone said, oh, I don't want to get that letter, I don't want to do this. My accountant, what he says when he gets an IRS letter, it excites him. Most people get afraid when they get an IRS audit letter. It excites him. And again, I've been audited, not one time, not two times, but several times. We've got about 7 companies. And they've all come back no change.
Yeah.
And so most people, I want to talk about one of the big misnomers of accounting. A lot of people believe in a concept called tax loopholes. Tax loopholes of the rich, and the one percenters are driving their Rolls Royce through these loopholes, and it's not really true. The tax code is about 5,900 pages. 300 of those pages are for W-2 and 1099 employees. The other 5,600 is nothing but a roadmap to tax-free wealth. The government wants to incentivize things that behoove them, things such as home ownership, things such as energy independence from the Middle East. So they're going to incentivize oil and gas investments. They're going to incentivize mortgage deductions. This is what they're looking to do. These aren't loopholes that somehow got through Congress. This is the plan on how to permanently reduce your taxes. Now, there's two things in terms of tax deduction, or in terms of tax reduction, that are very important. A lot of people look at tax deferment. Oh, we can defer it till next year. And a lot of people confuse deferment with permanent tax avoidance. And those are very, very different. One, you're deferring it to next year. The other one, you're reducing it permanently. A lot of people use those. They interchange them. They're not interchangeable. They're very different. You're, of course, looking for the permanent tax reduction, not the deferment. So just one point of clarification.
I love that. Well said, and great points. And with that, with the tax deferral, let me ask the entrepreneur two questions. Number one, do you think taxes are going up or down in the future? When I survey it, I've had one person in 5 years think they were going down. Happened to be a CPA, says we're going to a flat tax. That's it. Everybody else said it was going up. The second is, do you plan on having more or less money in the future? Do you plan on being more or less successful? Well, if you defer and there's a chance that taxes will be higher, which our average marginal bracket for the top level is historically low today, even though people don't necessarily understand that. But since 1913, the average has been well over 50% on the top marginal bracket. It's actually above 60% on the top marginal bracket. So if you defer your taxes into a higher bracket, you've actually got a tax adverse situation, or you got a tax problem that you face. And so we don't want to have that happen. I want to talk about the permanent solutions as we dive in today. And the first one is really important. It's that you absolutely have to have a tax team. See, if you're an entrepreneur, a lot of you own a building. A building is something that you typically want to have an engineer handling part of your taxes, not just a CPA. Or as you incorporate, which here's a tip. If you're not incorporated because your accountant told you not to incorporate, they are not a tax attorney or a corporate planning attorney. It is not their job to give you advice on incorporating. A lot of times it's simpler for them, or they get to just continue to file taxes the same way every year because you're not incorporated, but you will be overpaying tax and overexposed to risk and liability.
So when you're saying incorporating, I just want to clarify, you're not talking necessarily just an S Corp or a C Corp, but you're talking the hybrids of an LLC and an LLP as opposed to a sole proprietorship or a general partnership.
Just I don't want people to be a sole proprietor.
No, I don't.
And if there's advantages and disadvantages to each type of corporation. An LLC is one of the most flexible types of corporations, and it's great for a partnership. An S Corp is good for a professional a lot of times that is a single person that is the only owner, because they can do something called differentiate their income. And you can do this within an LLC as well. So here's your next tax tip, differentiating income. When you're a business owner, you have an opportunity to work in the business and to work on the business. When you work in the business, that constitutes a salary. Salary is subject to self-employment tax, and that includes some Medicare, Medicaid type tax. But when you're the business owner, and through scalability and leverage and knowledge and other employees, when you're earning excess money beyond your salary, when you're doing the actual technical work, but now you're thinking about the business and running a business, you can take a dividend. That dividend is not subject to self-employment tax, which is 15.3%. Now, there's a lot of people that go, yeah, but I'm pretty sure the Senate or the House has overruled that. Well, you're right. One of the two did, but the other one didn't pass it. And from the time I started to learn about this in 1999, I've always heard, well, they're going to do away with that dividend rule. And they've talked about it every single year, but it's never been done away with. Yet there's people that are missing out for over 10 years now on not having to pay an extra 15.3% on a portion of their income. So incorporating, which is either having an S Corp, C Corp, LLC, or LLP, and now how you take your income, those are two major factors in how much tax you pay.
Those are both really big. And when you look at what you need to do in terms of tax avoidance, setting up a structure that reduces your liability, business is a team sport. It's not an individual piece. If you're just listening to your lawyer, if you're just listening to your accountant, if you're just listening to your banker, you're going to be missing part of the game. So, for example, if you have a great accountant, if you have a great lawyer, or you have a great banker, one that you trust, one that you love, then I would ask them for a referral. Hey, let me ask you a question, Mr. Lawyer. Is there an accountant that you've worked with really successfully in the past? Oh, my favorite one is David Jones. Let me introduce you to David. And what you're trying to do is put together a team that hopefully isn't learning how to work together on your dime, and that work together pretty easily. So if you have one of those three that you love, or two of those three, it's really getting those three as a solid team to be able to come up with a comprehensive strategy.
Well, when I was 22 years old, I went to New York, and I bothered someone enough because I was just persistent that they allowed me to go in on some of their meetings. This was a renowned financial advisor. And we walked into something called a family services firm. We walked into this, and with the client, we sat around a table that had attorneys, accountants, investment professionals, the fiduciary. I mean, it was seriously every component. And from that moment on, I said, I have to build that for the entrepreneur, because you had to be worth 50 million or more to get into that room. And I was going, there's a lot of great people doing great things with tons of potential that have to have people that are aligned philosophically, communicate with one another. Otherwise, this fragmented planning is going to lead to leaks of money and cash. And that's what we're doing, is fixing the leaks. So let me review. Proactive. You want to talk to your tax team at least 3 or 4 times a year, because if you call between January and April, that's the busy tax season, and they're filing taxes, and most of the advice then is to put your money in a tax deferment plan, not into tax avoidance and permanent tax savings type things that you could have done along the year. So you have to have a bookkeeper, or you got to get your reporting to them in a timely fashion with all the information. The tax team could include an engineer, and I'll talk about why in a moment, a CPA, and a tax attorney. And then, because my tax attorney showed me a strategy where I could buy artwork at a major discount and 2 years later donate it, and I got $2 in tax credit for every dollar I spent on the artwork. I was able to display it and enjoy it for 2 years, and I've been able to donate it to causes that matter to me, and at the same time save taxes. The CPA didn't come up with that strategy, but the CPA is looking at my books and looking at my numbers from month to month to see and make sure every expense is accounted for that can be deducted. And then the engineer came in and did something called cost segregation. So if you own your own building, you want to write this down. Cost segregation. Normally you have to take 39 years to depreciate your building for tax purposes. But things don't last for 39 years. Things have to be replaced. Whether it's lights, whether it's carpet, whether it's paint. I mean, there's just so many different components. And an engineer can come in and study it and say, this is a 3-year depreciation, this is a 7-year, this is 12. And they start looking at all the different components, and you might be able to double or triple the amount of tax deductions you start getting today. Now, that could be a deferment if you don't know an exit strategy, but we happen to know that. It's called a charitable trust, a 1031. There's plenty of other ideas behind that, but I just want to start planting the seeds of all the possibilities there are out there to save tax. Now, the other huge strategy when you incorporate is that if you missed any tax deductions, which I highly recommend every 3 years, you get a different tax professional to give you a second opinion. Is there anything that they see that your current tax team misses? When I wrote the book, Killing Sacred Cows, I edited it myself. Then I handed it to an editor, and they found a ton of edits, and I was like, when I read that it was that way. We just start seeing things that we think are there. And so it's nice to have that second opinion, because every 3 years, you can amend up to 3 years of your previous taxes if you miss something, as long as you're incorporated. So amending is critical. Cost segregation can be big. Having the right corporation is absolutely important. How you take your income is absolutely important to what you pay in taxes. And being proactive is kind of the final piece to that.
Mm-hmm. Well, it's interesting. One of the things that a lot of people don't realize is, to me, and again, we're not tax professionals, although we've been doing entrepreneurship.
We played one on TV. No.
We stayed at a Holiday Inn.
Yeah.
And so we've done it for about 20 years. And one of the things that I've learned, and I had a mentor of mine teach me along the way, the least expensive way to own real estate is to have your business buy your real estate for you. And not only that, you get the tax shelter that Garrett was talking about, where you can depreciate the land for 39 years, but the building, the faucets, everything else depreciates significantly faster. So if you do that cost segmentation, you get a much larger depreciation deduction, which functions as a very effective offset, going back to the initial premise, which is it's not what you make, it's what you keep. Garrett, this has been an unbelievable segment.
Yeah, I hope that this helps you out, because when I talked to 117 people that we were working with one-on-one, which is just a segment of the people we're working with, 107 of them were overpaying taxes, and it was $11,300 per $500,000 of revenue. That was bottom line dollars. That's all 100% spendable, coming back, and for the most part, in the future, that's going to be coming in and year out until there's certain tax changes. So there is a lot to be said where a lot of people are going, man, I wish I had more money for retirement. I wish I had more money for my kids' school. It's like, you have it here if you have the right insight, you have the right eyes, and now that we provided you the right information. So now you can start putting these concepts on the ground. You can ask these questions of your tax professional, and you can start finding out what you can do to save more on tax and be better prepared for your financial future and improve your cash flow.
Awesome information. Awesome information. And so again, this is Robert and Garrett, and as always, live the life you love. We'll see you soon.